There's a question posted here. The question goes like this. Calvin Inc. is considering the purchase of new state-of-the-art machine to replace its hand-operated machine. Calvin's effective tax rate is 40% and its cost of capital is 12%. Data regarding the existing and new machines are presented below. So we have the details about the existing machine, the original cost of these two machines, installation charges, freight and insurance, expected end salvage value, and then depreciation method that is used. For both the cases, we have the straight line method. Expected useful life is 10 years, and for the old machine, the existing machine, and 5 years for the new machine. The existing machine has been in service for 7 years and could be sold currently for 25,000. Calvin expects to realize a before tax annual reduction in labor costs of 30,000. So what do we see here? The existing asset was already used for 7 years. So the remaining life here would be, say, out of 10 years, if it was already in service for 7 years, so it would be used for another 3 years. That's one part. Second part is it could be currently sold for 25,000, and we have the labor cost reduction in labor cost. Cost savings is also cash inflows only. So we have the reduction in labor cost of 30,000 if the new machine is purchased and placed in service. The question says, if the new machine is purchased, the incremental cash flow. We are asked to calculate what's the incremental cash flow for the 5th year. If the new machine is purchased and incremental cash flow for 5th year. So incremental is when there is a increase in the, or when there is a change in the cash flow because of a decision. The decision is about replacing the existing machine with the new machine. Now the life of the new machine is 5 years. The remaining life of the existing machine is only 3 years. 10 years out of the 7 years is already done. The balance of it is 3 years. So if the decision is to replace the existing machine with the new machine, so the incremental cash flows can be realized only for 8th year, 9th year, and 10th year. So that would be done. So that is in terms of new machines year life 1, 2, and 3. 4th and 5th years, there would be no incremental cash flow because see, by the end of the 10th year for the existing machine, it would be the 3rd year for the new machine. So 4th and 5th year, there would be absolutely no concept of incremental cash flow. Whatever is the cash flow is the cash flow which is realized from the use of the new machine. That's it. Now in this case, if the new machine is purchased, the incremental cash flow for the 5th year would amount to. So we would have these things as whatever is the cash flow. See here, we do not see any cash flow as such flowing into the business, but we see that there is reduction in labor cost of 30,000. So that will be considered as cash flow. So a reduction in labor cost, and that is 30,000. Tax rate is given as 40%. So %40 of 30,000, which will come out for is a 12. So 12,000. So we see cash flow after tax, which would be 18,000. Done. After that, we also see that the asset has a useful life of 5 years, the new asset. The new asset has a useful life of 5 years, depreciated um, using the straight line method. The original cost is 90,000, installation, freight and insurance. So these are the costs that have to be taken into consideration. So considering these amounts, the amount of depreciation also has to be calculated, because depreciation is an allowable expense. So on account of depreciation, they would be benefited, because of deducting depreciation, um, the tax benefit can be enjoyed. Tax benefit can be enjoyed to the extent of 40% on the depreciation amount. So let's calculate the depreciation amount on the new machine. So the next part will be depreciation on the new machine. So we would have the original cost as 90,000 plus the installation charges are 4,000, plus we have freight and insurance as 6,000. The entire thing divided by life is 5 years. So depreciation is 90, 100,000 divided by 5 will be 20,000. 20,000 is the depreciation amount. So tax shield on depreciation. So tax shield is equal to, now that would be at the rate of 40%. 4 2s are 8. So tax shield is 8,000. So overall, what is the incremental cash flow? Technically, as such, there is nothing incremental. Only the cash flows which are there in year 5, in the fifth year. Okay, cash flows in fifth year is equal to 18,000 plus 8,000. The benefit that would give us 26,000. So option D is the right answer. Option D is the right answer. I hope this is clear. Good day.